share any like confidential data, but I can share kind of my experiences through it. But forecasting is really an art, and you'll kind of get what I mean by that as we go through. There's definitely some science behind it, but everyone kind of has their own personal touch. So that's why we kind of call this the art of forecasting. So just a quick agenda. I'll kind of go through an introduction about myself, and then I'll go through kind of just the purpose of forecasts, a couple of forecasting methods, and then we can end with any open discussion or any questions anyone has. So to start off, I went to Clemson University in South Carolina, graduated in 2018, and I majored in financial mathematics. I was a part of the Cisco LIFT program. That's the Leaders in Finance and Technology. And it's a 2-year finance rotation program where you do 6-month rotations in areas of finance. And that you graduate from that program after 2 years. So I just graduated from that this past September. And now I'm supporting our global data center sales team. And then just a shameless plug, this is my dog, Chloe. I like to share a fun fact about myself all the time. She'll be 3 in January. She's a boxer lab mix. And because we're learning about forecasting, she's not great at forecasting, but she is certainly cute. So she gets her shameless plug in all of mine.
Oh, I think you might not, or the slides might not be sharing. They're not moving forward. We're still on the first slide, I think.
Oh, is it still on? Interesting.
Yeah.
More technical difficulties.
Oh, now you can see it. Yeah.
Does it work if I just go through it like this?
Yes. Yeah.
Maybe we won't go into mode. Okay. So I'll go back to my dog, just because you haven't seen them. Shane is cute. But we'll go into what is forecasting and why is it important. And really the key thing, we won't have the build outs here, so because I won't have the animations in this view, but a forecast is very simply just an informed estimate. And the key word here, it just can't be a guess. You need to have data to back it up. If I were to forecast the global data center sales that Cisco I'm on now, and I just came up with a number, and I tried to go give that to my manager, they'll call me on it. They'll call my BS and be like, show me the model that you used to put that. So you need to have data to back up your claim and to back up your model. And some of the key reasons of why we forecast, this is kind of where we can kind of get into some like experiences I've had after we go through the material. There's really countless reasons why you would need to forecast, but some of the big ones are corporate strategy. If we're talking about buying a company or merging with a company, you need to be able to forecast sales so that you know how much that company is worth to you. Manufacturing schedules, if you make your own products or even buy them here, you have to know what your demand is going to be and how much you're going to sell so that you know how much to order. If you order too much, you spend too much money and it goes to waste. If you order too little, you can't lose out on sales you could possibly have. Business and investment decisions, every decision in a business world will have an ROI. To calculate it, and you have to forecast it out. We won't make any financial related decision without looking at model after model after model. Sometimes it can be tiresome because you just kind of want to move on, but that's our jobs, especially with a publicly traded company, is we're protecting our shareholders' value. Companies, we need to make smart investment decisions and have lots of backup as to why we believe something is going to happen. And then talking about publicly traded companies, biggest things is Wall Street guidance. We have to provide guidance to Wall Street on our sales. And one thing that Cisco does is every quarter we go to an earnings call where we recap what just happened in the quarter that just ended, and then we provide guidance for the quarter that we're just starting. And judged by Wall Street, by investors, after that quarter ends, how we did against that guidance. So we need to be pretty spot on. If we can forecast 3 months out, hit those numbers, then it looks good on us. Even if we forecast negative, like a decline instead of growth, if we warn them about it, they'll know it. And then they know that we know our business if we hit those numbers. You don't want to say that you're going to grow at 5%, but you actually decline. That's going to look really bad on you because you didn't execute as a business and you didn't forecast it right and warn them of it coming. So since I don't have the bill in the presenter mode, I won't move on to this next slide yet. But it was kind of like a quick poll option just to do in the chat. How much you think, if you miss guidance over the next 2 days, does your average stock price decline? And I'll give you some options. Decline 1%, 2.5%, 4%, and 5%. So like your average decline over the next 2 days if you miss your guidance. And if anyone could tell me, because I can't see the chat right now, like the guesses are, like what the consensus is.
Someone said 4. There's 4 mostly, and some 5% and 5.5%.
Oh, I'm glad. Okay, we're in the right direction. I'm glad no one said the 1. And it's about 2.5%, but it actually is going up. This was from a Wall Street Journal article, maybe about a year ago. And a little bit more. There's been more turmoil in the markets. It's actually closer up to that 4% now, I think. But this kind of just underscores the importance of hitting guidance forecasting accurately. Because if you think about it, if you're just thinking about stock price declining 2.5%, okay, maybe that doesn't seem like a big amount. But think about it in terms of cap and shares outstanding for a company. That could be companies losing 5, 10, 15, $40 billion off their market cap just by not hitting a forecast that they gave 3 months earlier. So it really underscores the importance of one of the key finance responsibilities, especially at a company or any publicly traded company. I'll stop if anyone has any questions at this point before I kind of jump into some of the, and again, I can't see the chat, so if anyone could just read a question aloud or come off mute too.
I think there aren't any questions in the chat right now. Yeah.
Okay, cool. So like I said in the beginning, forecasting, which is an informed estimate, is really a balance of science and art. You have to have a good mix of both. In some scenarios, one more than the other, but you always need to weigh the two sides. So the science can support your conclusion using evidence, data, models. But where the art comes in is experience and assumptions you have to make and judgment calls you have to make. Nothing is ever as easy as just building a model and a number that comes out of the model. You then have to second guess the model every time. You have to keep digging into different models, reading the data. Does that model like an outlier? Is that causing your end number to be off? And does the end number really kind of match up with the state of the business economic environment? Like right now, COVID, if I were to go to my boss and say, oh, we're going to grow at 15% next quarter, he's not even asked to look at my model. He's just going to say, you're crazy because of COVID. Everyone, save for a few companies, are struggling a little bit more. So that's kind of where the experience and assumptions and judgment piece comes in. But in terms of building the full, there's no one right or wrong way. There's countless ways. So I'm just kind of going to talk through a few of them and walk through one of them just to make sure we don't run over too much on time. I could sit here and list 25 different models I've built over the past 2.5 years at Cisco, but we don't have that kind of time. So some of the key main ways are market share forecasts, linearity, and pipeline. And I have the arrow to pipeline because that's the one that we're going to go over. But basically, a market share forecast is thought of top-down forecast. So that's where, let's say, we'll use the WebEx and Zoom example, both in the collaborative space and environment. If Cisco is expected to have 50% market share and Zoom is expected to have 40% market share, some other competitors like Google Chat have the remainder mixed down, we should then expect to either keep that market share. Our hope would be that we could grow our market. We don't want to see a decline in market share, but that's kind of what you have to decide. You have to decide from that top level, how much market share should you have, and can you grow it or line? And then you kind of filter that down to all your different product lines and all your different products to forecast. The flip side of that is the unit forecast, bottoms up. So what that does is if you have one unit of product, so one Zoom license or one WebEx license sells for an average price of $100 per license. Well, how many licenses do you expect to sell? Times that by the selling price of $100, you now have a forecast. So it's the two opposites, starting from the top and filtering it down, and then the unit forecast is starting at the bottom and working your way up. So for a company like Cisco, where you have WebEx, you have data center products, you have switches, you have routers, you have wireless access points, we could build a company-wide by each product line, figuring out their unit forecast and their average selling price, and then adding those all together for like a Cisco Wast. Linearity fits into pipeline, so I'll go over that one second. But what pipeline is you rely more on your sales team to kind of tell you what opportunities they think they have over this next, if you're forecasting for a quarter. They have the relationship with customers. They're working on deals. They can keep a log of deals they're working and what they expect to actually be able to close over the next 3 months. And then we can look at that and say, using historical data, how much are we going to close over all of that? And that's how we build our forecast. And that's the model that we're going to go through. The linearity side is basically it's a checker. It's not really a building a forecast. It's to check a forecast you've already made. And we'll go through that right after pipeline. But basically what it is it says, if I have a forecast of $1 million for a quarter, as I go through the quarter, how much of that $1 million have I already hit? So if you're at 500, you're at 50% of your forecast. So that's your linearity. You're at 50% linearity. You then compare that to similar time periods in the past. And your hope would be that if you want to hit your forecast number, your hope would be that you're, for the same period of time, in historical sense, you're also around. If you're historically only at like 10% by that time and you're at 50, you're probably going to go way over your forecast. So you should raise. Or the flip side, only at 10 and historically you're at 50, you're not going to hit your forecast. So you need to lower it. So we use that as kind of a checker. But going line, I kind of came up with a fake company. I sat here last night actually just trying to make sure I wasn't using any, because we actually just finished a quarter and we're forecasting for a quarter right now. So all that data is in my mind right now. But I had to make something completely not tech related. Otherwise I might accidentally put some data in. Being a Clemson University grad, one of the things I didn't mention in the theme of this template is because it is orange and purple. And that is Clemson's colors, so that's why. So then I decided to keep that theme. Clemson is the Tigers, so I made the fake company Tiger Nation Incorporated. And what do we sell? We sell stuffed animals wearing Clemson sweaters. Where do we sell them? Primarily the United States and Canada. And what time frame are we trying to forecast for? And we're going to say we need to start planning for 2021, so we know how many stuffed tigers to order from our supplier. So that was one of the reasons that I mentioned I need to forecast. If you buy your products from a supplier to sell, you need to know how much to order. You don't want to order too many, and you don't want to order too little. You either waste money by buying too many, or you lose out on sales because you didn't order enough. So we're going to start forecasting for 2021. So to start by looking at prior year's results. So I have data from 2018, 2019, and 2020. We'll just pretend we're already at the end of 2020. And like I was saying, you have your pipeline, which is opportunities that your sales team is working on, and they think they have a chance to close this quarter. Your sales are what they actually ended up selling. So then they have a close rate, which is just the calculation of your sales divided by your pipeline. So in 2018, company-wide, they were working on $7,000 worth of deals, and they ended up selling 3,500 for a close rate. And then you can kind of go a level deeper. I said we sell in the US and Canada. Well, they might be two different markets. We're selling the same, maybe we're more successful in one than the other. And that's what you see here. So in the US made up the bulk of our pipeline, and they actually had a better close rate, 60% versus 25. So those are things that you'd want to keep in mind when you're forecasting. It may be you have to kind of in Canada individually and add them up to company-wide rather than just looking at company-wide. So similar data for 2019 and 2020. How are we going to look at 2021? Well, if we're using a pipeline model, we're going to need to reach out to our sales team and figure out what their pipeline actually is. They're working on deals. They talk with the customers. They know how much people are going to order. What data, what insights do they have that they can provide for us? So we reached out to them, and they think they have more opportunities. So you see, we're growing. We have $7,000 of opportunity in the first year, then 10, goes down a little bit to 11.4, then kind of speeds back up, and we're up at 14. And the breakdown is 10,000 for the US and 4,000 for Canada. The sales team is great at getting that data from, but if you go a step further, you don't really want to ask them now what are they actually going to sell, because the sales teams work on commission. They're going to tell you they're going to sell all $14,000, but we know from historicals here that just never happens. We never close 100% of our pipeline. So we then kind of rely on the finance intuition and the math behind it to actually tell us how much we're going to sell. What we'll do is we'll use the historical close rates and apply them to our current pipeline to see how much we're probably going to close. So if you do that, what I did was took the average of the US 2018, 2019, and 2020 sales close rates. So in 60%, 2019 it was 63%, 2020 it was 62%. The average of all that is 62%. Same thing for Canada. In the 25, the 30, and the 29, it's 28%. So this is what I was saying, is that you can look at the US and Canada individually and then roll that up to the rate it puts overall for the Tiger Nation company. One of the other things that you kind of have to watch out for with pipeline analysis is maybe just the simple average of the 3 previous years is not a good idea. If for instance, the US in 2018 was 60%, and in 2019 it was 40%, and then in 2020 it was 30%, well, we're declining year over year. Something's happening. We're not nearly as much as we were before. Something's happening with our sales team. Taking a straight average would be a really bad idea, because then you'd be including that 60% that already happened. And there's probably not a likely chance it's going to happen again if you already went down to about a 30% close rate. So that's not what we see in this example here, though, because it's 60, then 62. So all pretty much around the same. And same thing for Canada. It's 25, 30, and 29. So they're all around the same. But those are kind of the things that are outside that you need to think about. If you can't just plug in the numbers and have it spit out your model. You need to sit there and think, okay, do these numbers have to use? Can I defend these numbers if someone questions them? So those are the kind of things you have to keep in mind. Any at this point, because I'm going to jump into linearity after the pipeline model. I know I kind of just went through that kind of quickly, but I tried to make a simple. All right. So linearity is something where we're not just one and done. We don't just make the forecast, submit it, revisit it. We revisit it all the time. So if we, throughout the year, check our forecast to see if we're still on track and we can update it, get linearity. So let's just say through January, April, July, and October when we're looking at it. And you can see historical data here. So in 2018, in those time periods, normally we went from 14% of our forecast to 26% to 37 to 60, and hit 100% at the end. Same thing with 2019, 13, 27, 36, 58. And then 2020 was 16, 28, 39. Well, let's say in 2021, we're at 1,500. Well, of our forecast of 7,307, which was on our total roll up for Tiger Nation was 7,307. That's what we were forecasting for 2021. Well, when we're at 1,500, that's 21%. So now the question I'll pose to you guys to type in the chat: do you think we should update the forecast at this point? We're at 21 right now. Previously, in the previous years, we were at 14, 13, and 16. So we're definitely running ahead. Do you think we should update our forecast? If you just want to put yes or no in the chat. And then if someone could kind of call out what the consensus is.
I think it's a consensus of yes.
Okay. I mean, I like that answer because, and this is, again, one of the things that with the art piece is experience. I will say, I would say no, not update it yet. And the only reason I'm going to say that is because it is so early in the year. We're only like if our periods are January and October, we're only through one period. There's still a lot of time for stuff to go wrong. There is also a lot of time for things to continue going wrong. So yes, I would say you might want to update it because you are ahead, but also no, because it's still too early to decide that. So I would side with no on this. Normally, a lot of companies forecast on quarters, so 3 months. And what we do at 3 months, we revisit our forecast for the whole quarter. A lot of times after the first month, we won't actually make change cast. We'll start talking about what we could possibly change and start talking about if we're going to come in above or below our current forecast, but usually we'll wait until like a month to actually update the forecast. So what about now? So now that we're through April, we're at 3,000. We're at 41% now of our forecast. Because in prior, we were at 26, 27, and 28. Again, same question in the chat. I think you guys will be right this time. What the consensus on this one will be.
It's a yes. Yes.
Yes, I fully agree. Not only are we we're much further ahead now. We were only about like maybe 6-ish up last time. We're much higher than that now. So we're much higher. We're also another period in. So now we're starting to run out of time for things to go wrong. We're signaling to our management, to our employees, to Wall Street, if we had an earnings call somewhere in here, that things are starting to go different than we actually thought when we originally forecasted. So I would say yes, we now want to update our forecast. So now the question is, how do we go update it? You could use any of the methods of forecasting. You could create a brand new model if you wanted. You could redo your pipeline model, anything. And what I will say is you'll never only do, we only did the pipeline model here for simplicity. We would never decide a forecast just by doing a pipeline model. We would do a pipeline model. We would do a model. We would do a unit model. We would do a year-over-year growth model. And the hope would be that they all kind of point you in the same direction, because then you have a great amount of support for the want to forecast. If they all point in different directions, it then takes a little bit more digging. You have to figure out, well, which one do you trust? Which one does the data make the most? And that's where the art and the experience comes in. But one of the ways you can kind of qualitate how much opportunity there is to use your linearities. So like I was saying, in 2018, at that point in the year, you should bet at 26%. And then in 2019, it was 27%. 2020 was 28%. And right now we're at 41. So basically what we do is if our forecast right now is 7, and our 2021 linearity is 41%, the average of the 3 prior years says that we should be at about 2%. So we call that running ahead on a linearity basis. We're running ahead by 14%, the difference between 41 and 27. And the level of opportunity that we have, or risk if you're running behind, but here we have opportunity, is just the 14% times your current forecast of 7307 gives you 1,033 level of opportunity. So we might want to consider raising our forecast somewhere around $1,000. And that's a pretty big jump. I kind of made this model to show that on purpose. Running ahead by 14% is a huge amount to run ahead. But harder to see when I'm saying like $7,000. But imagine if this wasn't $7,000. Imagine if this was $7 billion. The business I support, the data center business at Cisco, is about an $8.5 billion a year business. So even if I'm only running percent rather than 14, that's 425 million. That's a lot of money to be either be ahead or behind. When you're dealing with much larger numbers, you really will never see that 14%. Because if you do, you really didn't forecast correctly the first time. See, you're running 4 points ahead, 5, 6. And that, with such large numbers like 8.5 billion as a base money. So you have to make sure that you keep up with that. And like I was saying, this alone does not tell me what to forecast. I'm not just my forecast $1,000. I'm going to go build multiple more models. I'm going to redo the pipeline. I'm going to reach out to the sales team and say, hey, we're running way ahead. Are we about to fall off a cliff? Like, have you kind of pulled in stuff that you expected to sell at the end of the year and you were able to sell it earlier, but now you can't sell anything else at the end of the year? Because if so, maybe we don't want to raise even though we're running ahead. Maybe we're about to run off a cliff and not sell anything anymore. But if they say, oh no, we still got plenty of options, you then feel more comfortable raising. You then go build your market share model, you build your unit model, and see if they're all kind of point direction, and you update your forecast. So just to summarize, forecasting is an informed estimate that is critical to make decisions. You have to balance between the art and the science. You have to balance what the math tells you with your intuition, with macroeconomic factors, with anything business related that you think would impact your number. And that's really where an analyst, that's their job. A computer can do a computer program can do the models for you. You can continuously run those models all the time and spit out numbers. The financial analyst, has to actually add value somewhere, and that's really on the and making those key decisions, key assumptions, and whether or not to trust the numbers or whether or not something in there is just a little bit off, makes it not feel right. That's where the experience comes in. No one is ever going to tell you that you're going to get 100% accurate forecast. We can get pretty close. We routinely get to be around like 102% of our forecast. So like if we were to come in over, we'll come in like 1 or 2% over our forecast. But that's because as we get closer, we keep updating our forecasts. If we were to forecast for an entire year in advance, and then you look at that original number we called at the end of the next year, we were probably pretty off. We were probably off 5, 10, 15% range, just because it is hard to see into the future and have a crystal ball. You rely on the math to tell you where you and then it's up to the people in the company to execute and do their jobs and to sell and to keep updating their forecasts to make sure things keep moving. But I do want to open it up if anyone has any questions. I know that was kind of just a really simple example, but like I said, I wanted to kind of keep it lower key for the amount of time that we have and kind of open it up more if you have any questions about kind of my experience as a financial analyst or anything. I'm happy to answer any questions you guys have.
I have a question.
Yeah, go ahead.
Yeah. How does the pandemic affect forecasting?
Yeah, so one of the things that you'll see followed any of like earnings announcements for a lot of companies, is when COVID hit, they decided to stop giving guidance. So during all, they would recap the quarter that just ended, but then instead of actually giving guidance for the next quarter, they would just have this blanket statement that said, not going to forecast because of the massive macroeconomic environment changes right now. And sure, that's valid, but Cisco is one of the companies that still gave guidance. So one of the things that Cisco prides itself on, sure, maybe we're not always going to grow at 5-10% every year. We're going to have years of decline, but we're always very upfront with that forecast, and we let Wall Street know that. So it doesn't come as any surprise. If you, like I was saying earlier, if you show that you know your business, it shows investors that you can run your business, and you want to, and they'll be more comfortable keeping their money in your company if you know how to run your business. In terms of the actual building the model side, like as the financial analyst person, one of the things, we haven't reached a full year yet. Cisco's fiscal calendar is on a very weird time frame. Our fiscal year actually starts in July. So we just started our Q2. So we're kind of ahead of other companies who are still 20 calendar. We're already in our 2021 calendar fiscally. We haven't yet gotten to our what we call compares until we hit our Q4, when we started seeing our COVID impact in our previous fiscal year. So our model building is still kind of the same as what we've always done now, because we're comparing to data that was pre-COVID. In a few more months, we're going to start forecasting where we're going to be comparing to data from last year that has COVID impacts in it. So what we have to decide as a company is, you have a few choices. One, ignore it completely. Just skip over that year, skip over the COVID data, the COVID impacted data, and just look at years prior instead. Or factor it in, but give it less weight. So like in a pipeline model, one thing that you'd see during the COVID environment is that let's say historically you're at 60% close rate. During COVID, you could see that drop down to like 40%, 35%. So now that you're going to forecast again, are you still in a COVID environment? If so, you might want to do a lower close rate. You might want to stay down in that 40%. Now you're out of COVID, you might want to ignore that 1 year of really bad close rates, and just go back to the higher close rates now that you're out of COVID. It depends on what your management decides what they want to do. So it actually adds extra stuff on. Basically what we do is we build the models all different ways, in both scenarios, and see if they kind of point you in similar directions. Long-winded answer that it makes it extreme, and you just have to kind of decide as a company how you're going to handle that.
I had a question.
Yeah.
So are like other like Wall Street like firms, are they also doing like running similar like businesses too, and like comparing that to things that like you guys are doing?
So like if I work for Cisco, am I running models on like Zoom's business to kind of compare?
Yeah, I guess. Or if you're like, I don't know, like an investment bank like is running forecasts on like Cisco.
Yeah, so I'll answer that second piece first, like the investment bank side. So in earnings calls, the main attendees are like people like you and I can to any company's earnings call, but there's people actually on the call that can ask like the CEO and CFO questions, and those are investment banking analysts, because what they do is all the companies that they cover, they're running models just like this, with whatever data they have available to them. Like they pipeline model just because they don't have the pipeline, they don't have that data, but they can run kind of like market share models. They can run like year-over-year growth rate models. So they will do all of that to come up with their own models, and then they fine tune them once we release our guidance. They try and see if they can get their models to match ours, so that as we are going into the next earnings call, they can kind of talk about whether or not they think. So they do all very similar stuff. They just have less data, less company-specific data available to them, because there's a lot of things that we don't publicly about our business, because competitors would use that information to their advantage. But with whatever data they have available, they will as many models as they can. We do the first part was what I was asking a clarifying question. We do have teams kind of in charge of the competition. We don't have like a team dedicated to Zoom, but we have teams that in our corporate FP&A department that do look at the macroeconomic environment and look at some of our biggest competitors, really more on that market share piece. Goal is to obviously have as much of the market share as possible. So they will run those types of models.
I think we have time for one last question if anyone has one.
If nobody has a question, I was actually wondering if I could jump in with one, because so I was wondering for large companies like Cisco, in practice, how much or how long into the future does it make? How many years into the future does it make sense to forecast? Since like the further away you're forecasting, the less accurate it's probably going to be. And I know for our forecasting template, it goes, I think, up to 5 years. So how does that work?
Yeah. So really, it's kind of a mix. In terms of what we tell Wall, we only give them a quarter in the future, because like you're saying, the further you go out, the more variable it becomes and less likely to be accurate. Tell Wall Street one quarter at a time. Internally, we forecast every month. We will update our forecast, and most focused on is the current quarter that we're in. That's the number that we're trying to get most accurate. But we do, when we're doing that, finish out the fiscal. And then at the end of every year, so the start of a new fiscal year, we will forecast that entire fiscal year and the 2 fiscal years. We call that long range planning. So basically what that enables us on the internal side is, even if it's not going to be accurate, we need some basis for developing new products, spending R&D money, finding new suppliers, building new products. You have to have financial backup to make key decisions that take years to unfold. Like, we can't just decide to build, if we didn't have WebEx, we can just decide tomorrow we're going to build WebEx and release it. It takes a long time to do those things. So we have to plan out as far into the future as we can to allocate funds appropriately.
Thank you.
Awesome, guys. Hope you guys liked the presentation. Feel free to find me on LinkedIn, ask me any future questions, and good luck with your project.
Thank you so much for taking the time to talk to all of us today. This was really informative.
All right. Thank you guys so much. See ya.